Okay, folks, welcome back. Today's going to be really short. My allergies are kicking my rear end. So you guys are probably familiar if you've been here for a while. The spring, I usually lose my voice due to the pollen. I'm really allergic to all the tree and grass pollen. With that said, this is our weekly chart for the dollar index. Just want to remind you of the SIBI here, sell side imbalance, buy side inefficiency. We finally made our way above the equal highs of the trading range in here. We mentioned that market structure indicated that we would see high probability run on liquidity above these equal highs. Now that we've taken the liquidity here, do we get up to the SIBI and close that in? That remains to be seen. Do we see continuation for the rest of this week? I'd like to see it manifest itself, but be mindful that it could hang around in here. It doesn't have to jump right up there and close that in. This is our weekly chart. So the range is, okay, it may require one more candle or more, not just this simple run above on one candle. In other words, this week right now, present week, it doesn't have to, and I wouldn't reasonably expect it to get up here and close that just this week. It may require next week or a little bit longer. Moving into our daily chart, a better representation of that. I mentioned 2 reviews ago that we would see large candles making a run to get above these equal highs, attacking large fund liquidity that would be shorting dollar. Again, they look at this as resistance like retail, so their stops would be resting above these equal highs. We mentioned there would be accumulation in here relative to the market structure. I don't want to rehash that here. You guys can watch that in the previous reviews. I do want to mention the accumulation relative to SMT. So this is our hourly chart on the dollar index, only focusing on the correlation aspects between euro dollar, British pound versus the dollar index. You can see here on Tuesday, Monday into Tuesday, the dollar was making no attempt to go lower after closing in a fair value gap. So this is a BISI, buy side imbalance, sell side inefficiency, and we'll look at that when we drop down to a lower time frame for the 15-minute time frame. But we can see the blue line, and it may be a little difficult to see, but I'll draw it out for you so you can see it. Here is the comparable low, and here is the comparable low here. Okay, so the red line is pound, and the dark blue is euro. Now this is inverted, so on the overlay it's mirrored to setting true. So what I'm showing is the relationship to if the dollar index and the euro and the GBP would be basically, positively correlated, not inverse like it is, or inverted. We would see it like this. But because it's negatively correlated, that means that when the dollar goes up, euro and cable go lower. So when we're looking at these lows here relative to the euro and pound, we're actually looking at comparable highs. And it may be a little confusing, but I promise it'll be clear when we drop into the euro dollar and pound hourly charts respectively. But we can see a strong crack in correlation like this. Now, I used to teach this in the free tutorials where I did not have it mirrored for cable and fiber. So I would look at the gap, okay, on the overlay where usually the fiber and cable would be up here somewhere, and the dollar would be, as it is here on the chart. And I would show graphically that there would be a divergence in the highs relative to the lows. And some folks could get that, and other folks were confused by that. Just like some of you are probably confused with this. And it's a matter of studying it. Okay, just know that if we're looking at SMT or correlated SMT divergence for the basis of accumulation, there has to be some narrative behind it. Otherwise, you're going to trick yourself into seeing what you may think is an SMT divergence when there has to be an underlying reason for it to occur, which I spelled that out in previous reviews, comparing the market structure on the daily chart for all the lows here, and that we were in an area where market structure would imply we'd see a bullish run with large candles to clear out the liquidity here. Okay, so again, it's not a, well, SMT is saying it's going to go higher, SMT is saying it's going to go lower, so therefore I'm going to trade based on that. You're using SMT as a confirmation to an otherwise bullish or bearish analysis relative to a daily chart. Okay, because institutional order flow needs to be determined without the referencing of SMT. SMT is a confirming tool. Okay, it's a like a confluence of things to support the idea that yes, there should be upward movement in dollar, and now we know there's a strong indication it's going to move higher because of the cracking correlation that was just shown on the SMT relative to euro and cable. At the same time, dollar index was making a BISI, buy side imbalance, sell side inefficiency, in filling that in. All right, so if we drop into the hourly chart again, you can see that we had a really nice explosive move on Tuesday, consolidated bullish order blocks in here, traded down into it, then aggressive accumulation, and then extended above the equal daily highs. I can't tell you how good it feels as a mentor to finally see this range break out, because I've been jawboning about it for months, waiting for it to do this, and we had to wait and go through periods of, I don't know, we'll see, and just let it be a lesson to you, because there's going to be periods like we endured this year so far where it's going to require patience, sticking to the tools, sticking to the method, and then trusting that it will eventually speak when it's necessary. Okay, but if it's unclear, there's a reason for it to be unclear, because there's really no significant move pending. Notice that we were already ahead of the curve expecting the rally in dollar. Okay, we're not expecting weakness in the dollar. We're not trying to call the top in the dollar. We didn't do any of that this year. We were saying that the narrative still looks as if that weekly imbalance should be a draw on liquidity. Those equal highs on the daily chart should be a draw on liquidity. So when that's the case, your daily bias going in, and you want to look for supporting evidence to the fact that if it's implied bullishness, then we have to look for supporting evidence to corroborate whether or not that is, in fact, a justified analysis. So, in other words, if our higher time frame daily chart is indicating that we are bullish going in every single day, your bias is a static bullish bias. That's plan A. But if you don't get anything to warrant something as a buy that makes sense and has sound analysis behind it, then you're just throwing orders in the marketplace expecting to get lucky. But if you look for imbalances and the retrade back to that imbalance, a fair value gap, or a run on sell stops for accumulation, then you have something to go by. But if you don't have those things, you simply have a bullish bias waiting for a setup. Okay? So, moving on into euro dollar. We finally got the movement lower on it as well. We were looking for these equal lows to be purged, and we got that. Liquidity has now been absorbed. Do we see a continuation down into the 110s? That's what I'd like to see on a longer term, but we could see some measure of retracement back up into these lows. And then maybe, depending upon what kind of candle we get next tomorrow, that would leave a potential fair value gap right in here. Okay, so we could see a return back to the midpoint of that, and that would be really nice to see as an opportunity to position more short term to swing lower for euro dollar. Moving on into a hourly chart, the fair value gap right in here. Okay, we have an imbalance, SIBI, sell side imbalance, buy side inefficiency. The top of the bottom of the gap rather is here, and the top of the gap is here. Notice how much time we spent banging on the bottom of that. Did it fill it? No. Remember, when I was teaching you last week on how to do back testing and also how to formulate a foundation to potential in the marketplace, some of you are still saying, and you see it in the tweets, and I'm getting it in my emails, I'm practicing my trades using the back testing idea, and you didn't listen. You already didn't listen. I said you're not trading that. You are to study it. And then you're sending me emails complaining about how you're not getting filled or you're getting stopped out and you're getting frustrated. And again, you didn't listen. This is the same thing that took place in the first year's mentorship group. The folks that were sitting with me every single day in those live sessions that you have recordings of, they were trying to do everything I was doing with live funds and then getting frustrated. When the whole concept was for you to sit there and study what takes place. That way, at the end of 6 months or 12 months, you would have a real world history of experience. Like you have tangible history and experience. You've seen price, you've studied it, so you know what's available. It's different than looking back and seeing, okay, well, yeah, I can look at an hourly chart or 15-minute chart and see what the euro did for the week. And I can easily go back in hindsight and cherry pick where this would be the entry and this would be the exit if it was a perfect world. And then you think that's enough. That's not learning price action. That's not studying price action. That's just hindsight reflection. When you go back and you, in depth, you really take it serious about collecting the data, seeing how many times the positions would be fruitful and how much time it takes for them to become fruitful when they would normally stop out. It's not entering trades, folks. If you do not listen to me in regards to this, quit. Because you're literally going to drive yourself nuts. And you're going to blame me for it. And it's not my fault because I've already told you, you should not be trading this. You're building supporting data to justify how often the setups will form. And then once you get this data going backwards for 4 weeks, we haven't finished the first week, this week right here. This is week 1 of 4 of back testing. Then after that, you got to do forward testing, where you're looking to do it as the market's creating the opportunities. You're already, some of you, are trying to trade on it and then complaining to me. It's the same. I even told you this in the videos, that this is what the first group that quit, those that did quit, over 200 of them, they failed. I didn't fail. They failed because they failed to follow instructions. And they attribute their failure to me not teaching it right, when I'm telling you exactly how to do this. But you cannot take my information from my brain, watch a video, and then all of a sudden assume that you know what I'm doing. You don't know what I'm doing. You're going to know what your setup is. You're going to know what framework your setup is going to be based on using this study method. This is exactly how I learned it. This is exactly what I was told to do. And this is exactly how I got it. Everyone I've ever trained that learned how to do this consistently has done this very thing. They are not trading with live funds. They are not sending me emails saying, I tried to use this fair value gap and it stopped me out. Why? I'm not going to answer those questions for you. That was the whole point of you studying for 4 weeks. You're supposed to be collecting the data, studying the examples when it failed. Not when it worked. That's the encouragement. But when it fails, There are certain signatures that repeat themselves, just like winning trade setups have repeating characteristics. The losing setups have repeating characteristics. Remember the parable of the Jade Master. The young man that comes to this Jade Master, he wants to learn how to be a Jade Master. He wants to carve and shape jade. So right away the old guy hands him a broom and says, okay, start sweeping. But while you're doing it, here, press this green stone in your hand and sweep. So what he did was he gave him real jade. He held on to real jade while he was doing meaningless tasks in his eyes. It felt foolish. I'm doing all this work for you. What am I learning? And this went on for weeks and weeks and weeks. And all of a sudden, one day he came in frustrated, much like some of you are sending me emails frustrated. I'm not getting this. You're not teaching me how to do this. You're just talking about it. And you're taking the trades and you're mystifying me on Twitter, but I can't figure this out. You're not teaching me. And what I'm telling you to do is go into the study and see when those things do not work. Because what that is, it's the equivalent of when the Jade Master handed him just a regular old green stone. And right away, the young man said, this isn't jade. And the Jade Master smiled. He has been teaching him the whole time. But you have to know what real jade looks like. You have to feel it. You have to work with it. It has to be utilized in your study, in your charts, not mine, not my commentary. It has to be in your analysis. And until I place it in your analysis by force, and that's what this is, you're not going to learn this. So you'll be pushing a broom longer, or you'll quit like some of those individuals did in the first year. Either way, I'm okay. I'm comfortable with either one, because I don't want you to be forced to be here, and I also don't want to sugarcoat it, make it seem like you're going to get this because you watched some videos. No, it's very expensive. You have to do some work. And this is how you do it. So, when we look at fair value gaps, that's just one component. Some of these people that started this year went to month 4 and said, okay, thanks, I've already figured this out. I'm not going anymore. I'm not going to do it anymore. It's all about imbalances. And then they're already emailing me, can I come back in? I'm screwing up. You're not trusting me. I don't know how else I got to prove to you that this stuff works. I mean, you see me doing it. You see me talking about it beforehand. So you have to listen. And some of you are saying, come on, get on with it, Mike. I'm already subscribed to this. I'm buying a hook, line, and sinker. I'm in. I'm following. Just keep on talking. You're going to hit a brick wall too. Somewhere in this mentorship, you're going to hit a brick wall. And I'm telling you to just trust the process. If I tell you to do certain exercises, don't look at it as a workout and say, well, I really don't want to do that. But I want to lose weight and I want to get fit. But I don't want to do the exercises that's necessary to do that. And I don't want to diet. I don't want to restrict myself from sugar. Okay, they're all the things that is human nature. Okay, but I'm telling you, those problems are yours. They're not mine. It's not a deficit on my part as a mentor. It's the inexperience and the immaturity as a trader because you want it right now. And it doesn't work that way. But it will work for you if you do what I'm telling you to do. You have to study, you have to practice, and you got to work out your perception. You have to build that muscle and understanding what it looks like. Because you don't know what that is for you and what that setup is, believe me, when you do this, your setup will start getting more clear. Oh, I see that. That's what I want. That makes sense to me. That's what I'm looking for. I want a New York setup that retraces after a stop run. I want to see a London Open, run the highs and then run into a fair value gap and then look for an expansion. I can't force a specific pattern or model on all of you because if it was that easy, I would have quit the whole teaching stuff and that would have been it. But I'm telling you how you get to your unique setup for your unique model. We are only talking about fair value gaps right now. We haven't even scratched the surface of what's available. This is just one of the easier ways for me to teach setups, framework, looking for institutional order flow, and waiting for a setup that has high probability. But what makes a high probability is you have to be able to discern whether the things that you're looking at are in fact high probability versus noise. Okay? So again, I just want to throw that in there because it's very important. Some of you are just simply complaining and crowing about I'm skipping over fair value gaps, and you missed some. It's not my job to do it. It's your job. I know which one's to trade off of. Think about it. You want to learn by me doing it for you, and it doesn't work like that. I had to study for years, and failed miserably a long time trying to figure out what was going on. I know what to do with them, but I can't bridge that gap in your understanding unless you do what I'm telling you to do here. And if you think that this is the only time you're going to have to work, believe me, it's worse than this. There's a lot more study and a lot more things. I told you in April, we're kicking it up a notch. And some of you are already tapping out saying, this is ridiculous. I can't do this. I don't understand what I'm doing. That's normal. But you're supposed to be still going backwards, looking back at every week as we finish it, study, go through every single day, find the imbalance during the London Open, the New York Open, and London Close, and Asia. Yes, all 4 of them. Some people are saying, I'm only really interested in New York setups. Do I have to do all of them? I'm only interested in London because where I live at, I'm only interested in doing that one. Should I do all of them? Yes. You absolutely need to do all of them. Again, I'm the personal trainer. I don't need to lift the weights. I already know what I'm supposed to be doing. I'm the one that has the experience. So you paid me to tell you what to do. If you don't want to do it, it's fine by me. But don't complain you're not getting the results. So this is the hourly chart. Okay, so I mentioned that I would be interested if we traded up on Monday and Tuesday of this week. If we traded up into that, that would be a level that I'd be interested in. I specifically noted it when we were looking at the 15-minute time frame. So let's contrast that real quick. Right in here, it's a little bit more refined to this level. Right. Oh, good grief. I hate when I do that. Okay, so we had, I'm going to take this one off and I'll put it back on in a second. Okay, so relative to the 15-minute time frame, this is what we would be expecting to see filled, but it doesn't have to fill. Remember, that was all part of the fair value gap lesson. They don't have to fill. It's just going to act as real support and resistance. Okay, it's not supply and demand zones. It's a delimiter for IPTA. It will go back to this level and key off of that. It may fill it, it may not. I don't have a crystal ball or a concept or a macro that tells me this fair value gap is going to fill. Notice what I taught you. I'm trading on the basis that it is not going to fill. So there's your answer, Matt. I do not know if the fair value gap will fill. I don't need it to fill. I don't need it to go back to consequent encroachment. I don't need that because I'm trading at the bottom of a bearish fair value gap and I'm trading at the top of a bullish fair value gap. And I'm allowing my money management to work with that setup as it is. So you got it now. Okay. So if we look at it like this, then sure, it's a very small little tiny little range. And no, it never traded there. But what is subordinate? The 15-minute is subordinate to the hourly, or the hourly is subordinate to the 15-minute? The 15-minute is subordinate to the hourly. So if we go back to the hourly chart, looking at it as we have here, it's a contrast to what we would expect to see on an hourly chart. This candle's butt end closed 1260, and this candle's opening 1260. That's a point at which buy side has been offered. On this single pass, this candle, it traded all the way down at one point to this candle's low. Then buy side was offered from that low up to the close. So right here, That's where buy side has been rebalanced. But it remains a gap between this candle's low right here, and this candle's close and open on this one. So we remove the 15-minute because it's, again, subordinate to an hourly. So the hourly, remember, top down, we're going daily, 4 hour, 1 hour. I'm skipping 4 hour lately because I want more definition, and I'm going right to the hourly. That's personally how I trade, because most of my trades are day trades or setups for one shot, one kill. And 4 hour, I can already see the levels that 4 hour shows. So it's just, this is my daily routine. I go in, I look at a daily 1 hour, 15-minute time frame. Then I just drop into a 5-minute chart and look for the imbalances, SIBIs, BISC, and stops. That's it. That's all I'm doing. And now I don't know which one's going to form unless there's an imbalance. When there's an imbalance, that's the first thing I look for. But it doesn't have to be that setup. It could be a stop run that formulates the entire setup. Okay, so again, this is where I was watching. We had multiple times we hit it, and then one more time here on Tuesday, hit it, bang. At the same time, we had SMT divergence. Now, again, this is cable. Notice that Euro had Monday's high, Tuesday's high, but look what happens here. Cable tears off and makes a significantly higher high on Tuesday relative to its Monday's high. Classic correlated pair SMT divergence. Heavy distribution. So that was a stop hunt on cable and just a return back to a fair value gap, bumping the bottom of the gap. That's your real resistance. Why didn't it go above these equal highs, Michael? It didn't need to. But if we were to go through several brokers, I'm certain that this candle here did in fact pierce somewhere. I don't know. I haven't done the research, and I don't care to know. I just know in my own studies that if we were to poll everyone on Twitter, these highs somewhere on somebody's platform, on somebody's broker feed, that got swept on Tuesday. Okay, so I don't need that. I don't care for that to be there. It doesn't need to be for my setups. So that's what we have here on the euro dollar. We had heavy distribution. Euro was unable to make a higher high relative to Monday. Big distribution day. And then the market coming off of its lows on Tuesday and then rolled over during today and Wednesday. All right, looking at the 15-minute time frame, you can see Wednesday, euro dollar was being heavily distributed, and the cable market tried to go higher at that same time, reaching higher for the day, making higher highs on the day, not being seen in euro dollar. So we have again another correlated pair SMT divergence, bearish because there's heavy distribution in euro. Same time accumulation was being seen in the dollar index. Then we saw price expand to the downside for euro dollar, and we're expecting this low to be broken and continuation moving lower. If I drop down into a 5-minute time frame, there's several imbalances in here that offered really nice setups. I'm going to throw on my intraday template, and you can see we have a nice draw down on price, leaving a porous wake as price drops down. So all of this SIBI, sell side imbalance, buy side inefficiency, has been rebalanced here. This high wasn't taken. Beautiful runoff lower. This one here didn't get filled. So this might be a measuring gap in here. So we could look at like this high down to this level here and then project that lower. That would indicate that we probably see maybe like 111.25, 111.30. Let me see what that looks like here. If that looks, I'm putting my fingers on the screen. Well, not technically looking at it, touching it, but yeah, that would be like 111.20. Let me see if I can get that to make more sense to you. All right, I'm going to scrunch this up. Now what I'm doing is I'm just roughing the midpoint of this single candle, and that would put us around, like I said, 111.30, 111.25, thereabouts. So that would be a nice extension. just to measure move ideas what I'm doing here. The low is 111.40, so 10 pips below that is 111.30, 20 pips is 111.20, 30 would be 111.10, and once we get close to that 111 big figure, all bets are off. Then we start doing that expansion 40 pips below that. So that would take us into 110.60. Okay, if we get some real acceleration on the downside and bullishness on the dollar. So that's the business there. Moving on into cable. This is getting a very, very long video. We have cable, met its objective down here. We said we expected to trade into the order block here. It did that this today. And looking very closely, you can see Tuesday, we had the market trade right up into what I've taught you how to do on our 5-minute back testing exercise. Teaching yourself institutional order flow and building the data on how much is available for setups. Well, here you go. You have this SIBI here, one single candle. Michael, I don't want to be a day trader. I'm so tired of doing intraday studies. I'm so tired of these examples. I signed up to be a swing trader. I want to be a position trader. And I'm not trying to make fun of you, but I'm just saying that's what I hear in my head every single time I see setups on a 4-hour, or if I see setups on a weekly, or if I see setups on, like it is here, daily. It's the same thing, okay? When we complete this study for fair value gaps, then we're going to go in there and we're going to look at stop runs. Then the same thing's going to happen there. And then we're going to do the same thing for liquidity voids. And then we're going to do the same thing for external range liquidity. Then we're going to do the same thing for internal range liquidity. You have so much work ahead of you, you have no idea. But if you're already complaining that you're not learning something, this is an example showing you just how myopic your view is. Single candle passing down. Previous candle's low, next candle's high. Right in here, what is this? It's SIBI, sell side imbalance, buy side inefficiency. Okay? Right away, the bottom of the gap, that's enough to go short if we trade back up to it. Right in here. So that price level would be 130.08. Okay, so that could be 130.05. Okay, or 130 big figure. The midpoint or consequent encroachment of that is 130.17. Okay, and we had a target of this order block here. So we could be a seller at 130.17 and a target of 128.90 plus spread. Now, you know my protocol, 10, 15, 20 pips ahead of the target. I'm trying to get out of there. So that would be 129.10. Okay, so 129.10 from 130.18. That's over 100 pips. One shot, one kill. There's your setup. Exactly what I've been teaching you the last week. All new setups, all new content. It's not rehashed from free tutorials, and it's not even from the first year mentorship. It's just taking the information and placing it into a usable format for study. Some of you are already over the moon right now about how much opportunity you're seeing because you're seeing exactly what you have not been able to perceive in price action, even though you've been through mentorship for several months or even through the first group. Now we're getting to the deep stuff where it starts becoming more practical. Whereas we learned theory, but now I'm putting it in your hands so that way you're using it now in a way and in a context that is going to be meaningful to you. Once you do that for a little while, then all of a sudden when I teach things inside of the price action models, it will be further amplified in your understanding. And then next year when we start going through, when we build actual literal trading plans on each model, then you'll know exactly what you're supposed to be doing. And then I can start to relax and not have to put so much content out. That's my goal. I want to get to the point where I'm just doing weekly reviews. Once in a while doing monthly teachings. But I don't want to be doing as much as I'm doing now because this is too much. So you're going to learn everything I promised. Tons of stuff still ahead, but just know that that's my goal. I want to get to just talking to you on a weekly basis, and then we all just do the same stuff within reason. So if we drop down into an hourly chart, let me zoom out a little bit here. You can see that distribution relative to the euro. Here's that Judas swing on cable. Goes right up to the consequent encroachment. Look at the high on this candle is exactly, if I can get it to pop up, the high is exactly 130.17. Come on, folks. That's not supply and demand. Okay? I don't care where you came from. These goobers on Twitter and on social media saying that I'm teaching you supply and demand. Again, Sam wishes he understood this stuff because it ain't in his curriculum. And people that have gone through it will tell you, it just ain't it. So, and it's not Chris Lurie's business either. So just be mindful that what you're learning, it's hard hitting, it's very, very unique, but it's also extremely precise. Extremely precise. So now notice what we have here. If you were looking at the fair value gap on that daily chart, what would be wrong if you sold short right here and it plowed into that 130.05 or 130.10 level even? Okay? What would be so wrong about that? Because we do have a short-term high here from previous Friday. Equal highs. Okay? Well, it's not equal highs. Sure it is. It's two candles right there stopping at the same level. To me, I look for that stuff. Remember, retail sees that as, well, that's a resistance level. Pseudo, quasi, tweezer tops. That ain't a tweezer top, Michael. It needs to do this and do that. Look, I'm just telling you how I think about it. But if we were to sit here and poll one another in the group, what would be inherently wrong with selling at 130.10 or 130.05? Nothing. You don't get the very high that the consequent encroachment provides, but you shouldn't be trying to enter at the consequent encroachment either. The benefit of looking at the fair value gap is it gives you a logical level to work with. And then you round that to a 5 or a 0 level, a 10 level, a 20 level, a 30 level, a 40 level, or a 5, a 15, a 25, you see? So it's a matter of what has price been reacting to in the last couple sessions. Is it really reacting to 0 levels or 5 levels? It's going to be probably sensitive to that. Not always, but it's just a good general rule of thumb. So if you're using that and you're calibrating your entry levels based on that 5 or 10 level multiple, don't beat yourself up about how if you got in here and it spiked up through here, well, I missed it, I'm not getting precise. Believe me, this is phenomenal if you just trade at the bottom of the gap. Look at what you have caught. It's beautiful. There's nothing wrong with that at all. So we have another area right in here, this level. Let me just create new lines. Now I'm probably going to throw you a curveball, but I'm just going to present it to you and you study it. There's our low, and here's our high. This is your sell side imbalance, buy side inefficiency, or fair value gap. All buy side delivery here. Price breaks down from this point or this candle's low. This is all sell side imbalance, buy side inefficiency. This candle, we open, trade up, offer buy side liquidity to this high right here. So the high is 129.63. This candle's high is 129.62. So we're off by 1 pip. Doesn't get up to that level. You miss all this movement here. But if we go back to this level, the high is 129.63. You do two things here. Remember, we're calibration. We do what? If we're below the low, if we're below the level, and if that level is 129.63, and we're coming up to it, and that's the bottom of the gap, do we use 129.65 and round up if we're below it coming up, or do we round down to the next 5 or 0 level? We round down. 129.60. The close on this candle comes in at 129.59. The high comes in at 129.62.5. This candle opens and creates a high good grief. The open is 129.60. So you have 2 candles, okay, or 2 hours to be in there trying to get that level. Now, on the basis of calibration, that you can't argue with that. And it's ahead of the gap. So we're looking at if they fill this gap all the way up to 29.75, and you're trying to get short at 60, which is a calibrated rounding down below the gap. So that way you're starting, some of you are already seeing that if you would have looked at these levels so far, studying it in hindsight and past data, some of the times the gaps don't get traded to or filled or consequent encroachment or the bottom or the top of the gaps that are traded to. The next level of your study, and I probably shouldn't be telling you this, but I just want you to remember that I'm taking you somewhere. I know where you're going, but you don't. Once you go through this study, the next thing you're going to do is you're going to look at your data and say, okay, now if I add the calibration of the levels, rounding down when I'm going short or rounding up when I'm buying, that's your level. Then you factor spread. That's all part of precision. See, you think precision is selling right at the bottom of the gap, or selling right at the midpoint or consequent encroachment, or selling right at the closure of the gap. I'm rarely doing that. I don't need that. This is the context of the marketplace. Then I want to be in the trade. You saw today I didn't get a limit order filled on dollar CAD. Just by a few pips, it didn't fill, but then screamed off, in my direction. Luckily, I scaled in on order blocks earlier. Otherwise, I would have had no part of that move if I was just leaning on the basis of that limit order, trying to go long. So if we now incorporate the calibration of the levels using 5 and 0 levels, but understanding the procedure is if we're under the level coming up to it, we round down. If we're above it coming down to a level that would be bullish, we round up. And then from that level, you factor spread. And then what that does, it gives you a finite formulation of stop placement, because then you know this is going to be my entry point at 60. So if it fills the gap at 15 pips above, then I have to consider what else could happen, the midpoint of or mean threshold of this bearish order block. So your stop needs to come about midpoint of that. So here we have, in context, it looks like this. So you need to have a stop that is above 29.93. How much above? Well, 5 pips, 2 pips, 10 pips, whatever your risk allows. Okay, so you know your entry would be 60, and then your stop would be above 93. So we'll say 29.95. That's a 45 pip stop. But you're also using an hourly chart. You're not removing the risk by working inside this fractal, this 3-bar candle. With that said, we drop down into a 15-minute time frame. I'm already looking at 45 minutes on this video. That's all right. You're learning. So if we look at this particular day here, if we were looking for a run into 60 as your entry, okay, you could have got a fill here, you could have got a fill in this candle, and you could have got a fill in this candle's opening. Maybe not so much on this candle because it opened and then probably immediately retreated from there. But once price, and let me get this overlay off now because it's going to get in my way and distract me. Okay, so we have price creating a run to that 60 level, and then we have price break down. The market opens here, trades up into the order block, right in here, then sells off. We can wait for a imbalance to form. We don't need to be up here. So if you miss this move, or if you miss the order at the bottom of the gap, so because it doesn't really trade to it here, do we completely remove the idea of taking the trade? No. You wait for a fair value gap to form. Well, you have one here. Right here. And this candle right there. Single candle, SIBI, sell side imbalance, buy side inefficiency. If we traded at high again, which it does it here, you can be a seller. Then you would simply put a stop above a swing high. In here, we have the last up close candle. Not so much a swing high in here, If we drop down to a 5-minute chart, there's a swing high in here. And I'll show you what that is right there. And drop into a 5-minute chart. Right here's your swing high. So your stop would be above here. Okay, so 129.47 and selling short at 28. So we are not using a 45 pip stop loss now. We now just dropped it to around 19 pips. Okay, so 19 pips risk above the swing high here. And there you go. You could use this swing high here also because it's above the fair value gap, and that could reduce the stop and risk. So you have 129.41 with an entry at 28. So the risk drops again. This candle here is also a swing high. See how we're doing this? We're refining the risk, reducing the risk, and still trading the same setup. This candle's high, 29.40. This candle's high, 29.40, slightly higher with the pip at. And in the lower high here, obviously, you can see that without being shown. But still a swing high. You can see that. I don't even need to zoom. You can see that it's higher. That's a 3-bar fractal or 3-candle swing high. That's all I need. And that's where I would put a stop at just above. Okay, so in this case, it could be 129.41 or 129.42. And filled at, or trying to get filled at 28. So your risk is about 14 pips or so risk to make 39 to 40 pips profit. So that's a nice risk to reward model. And it's all based on fair value gap. And I just gave you a complete trading model right here. The direction I'm taking you leads to these things here. Okay, these are scenarios and setups that I would do this and then share it on Twitter. I would execute on here and then share it on Twitter. I always exit early on Twitter because I'm not trying to teach the mentorship. I'm not trying to teach my exit strategy. I'm not trying to teach institutional order flow. I'm not trying to teach anything except for consistency. That I have it and I can show it. And if I can do it using the stuff that I teach, you try and practice how I teach you in the study methods, then you should be able to arrive at that same goal. How long it's going to take you to get there, I don't have an answer for that. But I do know that everyone that gets there goes through the same process I've given you and I'm giving you presently. Okay? All right, last bit of business. Looking at dollar CAD. Right away, you're probably saying, what is all this? This is obviously the run on the rate announcement today that we are looking for. It's funny how that volatility stuff works. This is the order block. I was doing entries on that. And into this candle here, I was trading on this order block. And then my stop was below here initially. Price rallied and you watched me do that and I exited as you saw on Twitter. The daily chart. We have all of this imbalance in here. Right in here. But if we go out to a weekly chart, watch what happens. Why did it stop right there, Michael? Well, if you look at, let me see if I can get this thing to scrunch up a little bit more. Make it a little bit bigger. That's better, yeah. All right, so we have this candle's low. Okay, 135.63. And then we have this candle's high. 134.66. If you take that range and you get a complete measurement of that just for Fibonacci, you can see the 50% level is right here. That's what's being indicated here. So the shaded area is the range that makes the fair value gap. Okay, and if we take the fib now off, this level is the consequent encroachment, or basically what would be permissible without having to be filled. This would be a high probability level. If I drop into an hourly chart, you can see, look at the sensitivity there. Now, yes, you're going to argue, oh, well, it didn't stop right on there. it went 2 pips above it. So again, I'm working with a retail feed here. So there's going to always be some measure of variation. On a 15-minute time frame, again, you can see the big run here. Boom, hits it, bodies stay way below it, and we'll probably just start to drift up there and then make a meaningful run and close the gap up. How long is it going to take to do that? I don't know, but I'm already done for the week. Again, this is how I trade, folks. I do the same stuff every single week. I want 50 to 75 pips. If I can do it in one setup, great. If I require myself to do it over several, then that's what it's going to be. But I want to back off and go back to how I really trade, which is looking for one real good setup a week, because one shot, one kill is not what I've been showing on Twitter for months and months and months. I just wanted to answer that common repeating email question or by trolls on Twitter. You don't ever really show a track record. You don't trade. You use different accounts, yada, yada, yada. So you guys watched me do all that stuff for almost 2 years. I'm burnt out with it. I'm just tired. It's lost its interest to me. And if I don't teach anybody to trust me from that, then I'm never going to teach anybody to trust me with anything else. So, and I really don't care. So, anyway, that was important today. Consequent encouragement of that weekly fair value gap. All that stuff is the same thing we were talking about on a 5-minute chart, right? I mean, it's the same stuff. All we're doing is using one single ICT concept, the fair value gap. How many PD arrays did you learn about in month number 5? All that stuff is multiplied on each individual concept. And then there's tons of things beyond all that. Okay, there's things that I haven't taught yet because there's too many people just tossing this stuff around, okay, like it's meaningless and it doesn't have any value. I have to frame the teachings in such a way where I feel comfortable doing it. So right now we have a ton of stuff to work through. We have years worth of content to work through and refine and build. And I don't have to teach you anything new, but just what to do with the things I've already taught. And that's years worth of stuff. So don't be in a rush. There's so many things to learn, but I want you to be at least more confident that you're in the right place and you're getting more insight, you're getting more understanding. Things that are being taught are starting to gel, starting to come together, dovetail nicely. That's the whole point of the mentorship. That's what's supposed to happen. You're supposed to be in the community here and you learn. There's no more pressure about paying me. There's no more rushing about, well, it has to be done by this time. It's just comfortably taking a step back and saying, okay, what are we talking about each week? Wednesday and Friday or Saturday when I do the review. What am I pointing at? I'm taking your attention to specific levels. You're supposed to go through and look for the PD arrays that you learned about in month 5. Which one do you like? You're going to gravitate to one initially. Most of it's order blocks. When I released the fair value gap, a lot of people like that. But now, because, like, I don't mean to beat you up, Matt, but like Matt said on Twitter, he's frustrated because sometimes the gap fills and sometimes it doesn't fill. And if it doesn't hit the level, you got to go from the hierarchy of the higher time frame down. And as long as the model or setup permits you to trade with your money management, you don't need that gap to fill. You don't need consequent encouragement to be traded to like it does here. It just means that if you get that level and it's at a time of day and a day of week that would be a confluence of things supporting a higher time frame institutional order flow, you have a lead pipe cinch trade. Not perfect. It just means you have such a high degree of probability behind that setup. Why not take it? You just have to learn how to frame your risk. What happens if you get stopped out and you put your stop loss in the wrong place, but the setup's still there? You enter it again. It's that simple. A lot of you are going to have a sticking point there. You're going to do it, you're going to get stopped out, and you're going to get scared, even in a demo, because you don't like failure. I get stopped out once in a while. If the setup's still there, I'm right back in there again. That's what comes by studying and doing it efficiently, doing it the correct way. I'm not wasting your time. I'm not going to tell you to do things that's not going to be fruitful for you. But if you don't listen to the things I tell you to do, you have nobody to blame but yourself. So I think we have a little bit more room on the upside for this. Again, how long it takes to get there, I don't know. Personally, I'd like to see it plow right on through this high and not even be a barrier. I think it has that in it. I think these equal highs here are suspect. I think that will, at some point, make an attempt to get above that. So, 136.65, 136.80. That's my long-term horizon. That means like quarterly shift type thing. That's what I'm looking for. But we have to contend with this level first and get through it, and then go back up to this level if at all. And then how we trade here, we have to weigh all that stuff out. And then you can see why I don't like position and swing trading, because there's too many variables. I don't like that. I like day trading. I know where the liquidity is. I know my setup. I'm going to get in there and I'll have velocity behind my money. I can build it quicker, turn it over faster. Swing trading, position trading, and again, I'm not trying to talk you out of it, because if that's your cup of tea, then that's your cup of tea. But I just think once you do it for a while, you'll outgrow it and you'll want to have more action. Not that that's a good thing, because you can turn into a junkie, but you'll learn very quickly that you can, again, use velocity behind your equity and parlay it up a little bit more. I'm not trying to tell you to run the accounts up real fast or expect to be able to do that, but you just know after looking at it, there just isn't enough setups, to keep me satisfied. And I want to be in there doing something all the time. And day trading and scalping allows me to do that. So that's that. S&P real quick. Here's where we're at. We had a liquidity pull above here. The market created an order block in here, traded down into it several times. Launched up. We are creating equal highs here. We have these sell stops that have been taken. I want to see this kind of like hold this consolidation and work towards going higher. We have a potential Artemis in here. Okay, and watch for that 129.30 to 129.32 level. That might create something. Maybe an order block forms in there. We might get some expansion on the upside, clear that, and run to new all-time highs. That's what I'm holding the balance for in here. Stop staying way below. I don't want to get tagged. And it's also being kept below the equal high. So I've already taken 4 off, and you can see I only have 1 remaining. So that's that. What do we do when we get to all-time highs? I don't know. We've never been here before. So I'm interested to see what happens. I wouldn't be surprised if we see a significant sell-off. Does it top and crash the market? I don't know. Could. I don't know. I'm not saying that. I'd like to see it screaming to 3,000. To me, 3,000 for a couple of years has been, to me, like the number I think it wants to go to. Does it need to go there? I don't know. I don't have anything to go by except for it's a nice round number above where we traded to. And, if we continuously trade higher than that, then great. But I don't have a target. And a lot of people are asking me in the mentorship and outside the mentorship, where do I think stocks are going? Where do I think the index is going? I don't know. I just know that I'm looking for all-time highs to be swept. And then how we trade there, I'll have an opinion once we get there, I'm sure. But for right now, I don't know. I have to wait to see what happens. And you can see what I have in place and how I'm working it. So let me scrunch it down. You can see there's my target right here. So if we run up there, then you know that 129.48, that fills me, and I'm out. I'm done, at least for this position. And then I'll look for something else. So that is going to be it, folks. Hopefully you got something from this. I didn't want it to be an hour-long video, but it is what it is, I guess. So I will catch up with you guys on Friday. Let me rephrase that. I will catch up with you on Saturday. I already know I'm going to be doing something Friday evening that's going to prevent me from doing the weekly review and posting it Friday night. So it'll probably be a 1 p.m., 2 p.m. thereabouts on Saturday, my local time, for the weekly review. And until I talk to you then, I wish good luck, good trading.